We just had another wild week for the stock market, starting off the week with nuclear war talks. After that, we had the Fed minutes, where a mystery Fed member was calling for 50 basis points at the last meeting. And then finally, you had a higher than expected inflation reading coming out on Friday, which sent the market from $403.06 all the way down to $396.38 to end the week, for a drop of around 1.7%. But how did we get here? We started off the week on a bad note with nuclear war talks after Putin decided to cancel the START treaty, which limited the amount of nuclear testing that could be done outside of their borders. But they did say this was reversible if the US and NATO decide to de-escalate the situation in Ukraine, or in other words, stop sending artillery over to Ukraine and helping them out. On top of that, for Tuesday, we got services PMI coming in much hotter than expected at 50.5 versus 47.2 expectations, and this was up from 46.2 at the last reading. This could be possibly signaling higher services inflation to come, because this is the servicing industry and the purchasing managers for the services industry, which are expecting their economy, their part of the economy, to be doing well over the next year, which means that they can continue to raise their prices, which means more services inflation to come, which is exactly what the Fed doesn't want. So rates ended up climbing on this, and SPY ended up coming down. And then on Wednesday, you had the Fed minutes increasing the rates even more, even though this is usually a nothing burger. Nothing usually comes out of these events, but we did have that one mystery Fed member coming out saying that they wished for a 50 basis point rate hike at the last meeting. We know that Bullard and Mester said that they wished for a 50 basis point rate hike after the meeting, but we don't know who the third member is. And my best guess is that it was probably Kashkari, considering his interview with CNBC, where he joked about raising rates possibly all the way to 10% for the federal funds rate. CNBC anchor was pissed about it, but he might be the third member that's calling for 50 basis points. So this meant that the odds for 50 basis points at the March meeting ended up climbing from 18% at the beginning of the week to 27% by the end of the week. And if this continues to climb, and if it's above 50, that means that we're going to get a 50 basis point rate hike for March, which will be bearish for the markets, expecting 25 basis points. On Thursday, we got the GDP reading coming in at positive 2.7% growth quarter over quarter, revised down from 2.9% growth as of the last month, which means that we're seeing cooling growth in the economy, which is exactly what the Fed wants. They want to have growth in the economy. They just want to have it at a slower rate compared to last year. The quarter over quarter growth was 7%. So we're definitely seeing slower growth in the economy, which is what the Fed wants, but they don't want us to go negative because they don't want us in a recession. They're pitching the soft landing, so if they miss the soft landing, that would be bearish for the market. After GDP, we got the initial jobless claims coming in at 192,000 versus 200,000 expected, so just slightly worse than expectations, and this was down from 195,000 at the last weekly report. The continuing jobless claims, or the total number of unemployed people, though, came down to the February lows, which means that we're not making any progress in the labor market and cooling it off, which means that this is inflationary until the Fed is able to reduce the amount of jobs available compared to the number of people that are unemployed. So either you increase unemployment or you decrease the number of available jobs. And then finally on Friday, you had the core PCE, or the big report of the week, the inflation report, coming in at 0.6% month over month versus 0.4% expected. And this is up from 0.3% the month prior. And even the year over year reading came in higher than it did last month, which is the first time that we've seen in a while. So since inflation came in hotter than expectations, SPY ended up selling off on Friday. Again, we started the week at $403.06, and we ended the week at $396.38. So that's the macro recap for this week. And then for earnings, I was watching three stocks: Walmart, Nvidia, and Moderna. Walmart came in at $171 earnings per share versus $151 expected, so this was a 12% beat on their earnings per share. Their revenue came in slightly better than expectations at $162.7 billion versus $158.7 billion expected, so a 2.5% surprise beat. But the problem was that they forecasted lower earnings in the next quarter of 125 to 130 earnings per share, whereas Wall Street was expecting 136. Hence the drop that Walmart experienced at the end of the week. And then Nvidia came in at 88-cent earnings per share versus 80 cents expected, so this was a 9.5% beat. And the revenue came in slightly better than expectations at a 0.5% beat, coming in at $6.05 billion versus $6.02 billion expected. On top of that, you also had their guidance coming in better than expectations. So this was what's known as a triple play, where they have an earnings beat, they have a revenue beat, and they have an increase in guidance. So their stock ended up rallying about 10%. And now they're trading at the same price that they were 1 year ago to date, even though their earnings per share is down by 33% and their revenue is down by 21%. So they're having multiple expansion during a time of financial tightening or when rates are going up and the Fed is selling off with their balance sheet. And the potential for growth here is all about AI, which they ended up mentioning 75 times in their earnings call. So all the growth is all based on AI. If NVIDIA is able to capitalize on AI like they're expecting, then maybe they can warrant these higher multiples. But if they can't capitalize on it, then the stock is way overvalued. And then finally, you have Moderna coming in at 361 earnings per share versus 460 expected. This was a 21.5% miss. The revenue came in just above expectations at $5.08 billion versus $5.02 billion expected for a 1.3% beat. And the big problem with their earnings is that they only contracted $5 billion in COVID shot sales for 2023, when they did $5.08 billion in revenue just for this quarter. And this was the one stock that I had the right analysis on, but I didn't end up trading. Instead, I got a pie in the face from both Walmart trading a put credit spread and an NVIDIA call credit spread. But hey, better luck next week. With the upcoming events, we have Monday, the core durable goods coming in at 8:30 in the morning. I don't think this is going to be volatile in either direction. I think that SPY is probably going to trade in a range of about 392 to 399. I already opened an iron condor accordingly. And then for Tuesday, you have retail inventories coming in at 8:30 in the morning, with the latest report coming in at positive 0.4. And if we get another positive reading, this would be disinflationary because retailers have more on their shelves, which they need to get rid of by lowering their prices. So this would be bullish for the market. And then if the reading comes in negative, that will be inflationary because retailers can raise their prices, and this would be bearish for the market. After that, you have consumer confidence coming in at 10 in the morning with expectations at 108.5 versus 107.1 prior. And this will be a higher reading than what we saw for March of 2022, whenever fiscal tightening started or whenever the Fed decided to start raising rates. So the consumer is more confident now than they were before financial tightening started, which doesn't make a lot of sense. But if this comes in higher than expectations, that would mean that rates would probably need to go up in order to cool off consumer confidence, which would be bearish for the market. And then a lower than expected reading would mean that rates would go down. That means that consumers are expecting the economy to slow down, and that would be bullish for the market. And then on Wednesday, we have manufacturing PMI coming in at 10 a.m., expected at 48.0 versus 47.4 at the last report. A higher than expected reading would mean that manufacturing is picking up. That means that there's more goods that are being put on the shelves, which would be disinflationary, which would be bullish. And then if we get a lower than expected reading, that means that there's going to be less goods produced, which will be inflationary, and that would be bearish for the market. That's on Wednesday, and then on Thursday, we have the jobless claims coming in at 8:30 in the morning, expected at 197,000 versus 192,000 the week prior. A higher reading would mean that we have a softening labor market, which is what the Fed wants. That would be bullish because rates would come down. And then a lower than expected reading would mean that there is still a hot labor market, which will be inflationary, which is bearish for the market. And then after jobless claims, we have non-farm productivity, which is basically GDP. And this is expected to come in at 2.6 versus 3.0 at the last reading. A lower than expected reading would mean a slowing economy, which would mean lower rates, which will be bullish for the market. And then a higher than expected reading would mean a hot economy, an economy that's growing too fast, which means higher rates, which will be bearish for the market. And then if we have a negative reading for non-farm productivity, which is unlikely, but if it does happen, that would be a contracting economy, which would mean a recession, which would be bearish for the market. And then finally, Friday, we have services PMI coming in at 9:45 a.m. I think this is going to be the big report of the week, just like it was for last week. And the prior reading was 50.5. We don't have any expectations set for this just yet. But if this comes in higher than it was last month, that would be inflationary. That means that services purchasing managers are expecting the services industry to continue to do well. They can continue to raise prices, which would be inflationary and bearish for the market. But if this comes in lower than it was at the last reading, that would be disinflationary and bullish for the overall market. And then finally, you have non-manufacturing PMI, which is kind of similar to services PMI. And this is expected to come in at 54.5 versus 55.2 at the last reading. Again, this is similar to services where if we have a higher than expected reading, that's inflationary and bearish, whereas if we get a lower than expected reading, that is disinflationary and bullish for the market. So that's the macro that's coming up for this week. And then for earnings, I've got 3 stocks. I'm watching Zoom, Target, and Costco. For Zoom, they're reporting Monday after hours. The earnings per share is expected to come in at 80 cents versus 21 cents at the last quarter and 75 cents a year ago. And historically, over the last 8 quarters or over the last 2 years, they've done 84-cent earnings per share per quarter. But this has been declining in recent quarters. And then their revenue is expected to come in at $1.1 billion versus $1.1 billion at the last quarter and $1.07 billion a year ago. So this means that their revenue is starting to decelerate, with their historical revenue coming in at $1.03 billion per quarter over the last 2 years. But the problem with Zoom and trading against them is that they've made so much profit over the last 2 or 3 years, and they can use this to buy back shares of the stock in order to increase their earnings per share. So I'm not sure on the 80-cent estimate. They could come in slightly higher, but if they do end up missing on their earnings, this could be a decent sell-off. After that, we have Target coming in Tuesday in the pre-market. Expected earnings per share is $1.39 versus $1.54 at the last quarter and $3.19 a year ago. Historically, they've done $2.54 earnings per share over the last 2 years per quarter. The revenue is expected to come in at $30.7 billion versus $26.1 billion last quarter and $31 billion a year ago. And their historical revenue has been $26.2 billion as of the last 8 quarters. Target stock was already down in sympathy with Walmart stock after their earnings report, but I think that they could post a more significant beat than what we saw out of Walmart. So Target might end up seeing a recovery after their earnings report, in my best guess. And then finally, we have Costco reporting earnings on Thursday after hours. Their earnings per share is expected to come in at $3.21 versus $3.10 at the last quarter and $2.92 a year ago. And their historical earnings per share has been $3.15 per quarter for the last 2 years. The revenue is expected to come in at $55.5 billion versus $54.4 billion as of the last quarter and $51.9 billion a year ago. And their historical earnings per share over the last 8 quarters has been an average of $53.9 billion. And considering that food prices are still on the rise, I do think that they could end up beating their earnings per share. I do think that they could beat on their revenue. And Costco might see a decent earnings report and their stock might go up. But where are these stocks going to go? Let's check out our technical analysis. For SPY, I've got it in an expected range of $389 to $404 based on the Friday's expiration date and the implied volatility of this. For support levels, you have the 395.25 mark, you have the 389.75 mark, and then the 386.58. Below that, you have a Fibonacci retracement from the bottom of COVID to the top of the bull market, which was $380, and then you have a Fibonacci above at $418.21 that the market pivoted on since the end of the bear market rally. And then for resistance, you have 397, you have 401.44, and then a top resistance of 407.51 for this week. And then you're also approaching the mother of all trend lines, or the line, as a lot of people like to call it, which started at the top of the bull market and has been descending ever since. So if we end up cracking this, technical analysis geeks are going to sell off, probably down to the 386.50 mark, but we have to go below it in order to really confirm that. Now for the events this week and my expectations, we have the durable goods, which I'm expecting to be non-volatile. SPY is probably going to trade in this range of 392 to 399, like I said earlier. Then you have retail inventories coming in on Tuesday. I expect this to go above $397 if this is higher than expected. If this is negative, we could be below 395. And then for consumer confidence, if it comes in hot, that means that we're probably going to go below 393. Or we're going to go above 399 if this comes in lower than expectations. For manufacturing PMI, I think this is going to be non-volatile and we'll probably be trading in a pretty wide range of 390 to 400. And then if we get either a high or low jobless claims, better or worse than 5%, we're probably going to go below $394 for SPY. But then if this comes in neutral, then this is probably going to trade between $395 to $399. And then after that, you have non-farm productivity. If this comes in negative, we're probably going to head below $391. Probably going to be tagging that mother of all trend lines. But if this comes in positive but lower than expectations, we're probably going to come to $394 and above. And if it comes in positive and higher than expectations, I think we're going to be below 393. And then finally, services PMI. If this comes in higher than expectations, we're going to go below 390. And then if it comes in lower than expectations, we're probably going to go above 395. And finally, the non-manufacturing PMI, probably going to be non-volatile just because it's mostly based on services PMI. So whatever services PMI does, non-manufacturing PMI is going to be the same. And then for the earnings reports for this week, Zoom is expected to be between $64 and $84. We have some supports at 71, 69.76, and 66. And then we have resistance at 74.50, 77.44, 79.77, and 84.50. If their earnings per share comes in better than expected and the revenue comes in better than expected, I think that Zoom is probably going to go above $80. If their earnings per share beats but their revenue misses, I think that it's going to stay above $77. A call debit spread would probably be the best for that. And then if their earnings per share comes in worse than expectations and the revenue comes in better than expectations, the stock might stay above $71. So a put credit spread would probably be your best bet. And then if their earnings per share comes in worse than expectations and the revenue comes in worse than expectations, then I can easily see the stock going below $70, which would be best fitted with a put debit spread. And then for Target, the expected range is between $152 and $182 for this week. We have some supports at 164.04, 158.49, 154.51. You have resistance at 168, 173.14, and 180. If their earnings comes in better than expectations and their revenue comes in better than expectations, I could see this going above the 173 level. If the earnings per share comes in worse than expectations and the revenue comes in better, I think this is probably going to stay above 164, so you would probably use a put credit spread. If the earnings comes in better but the revenue comes in worse, then it's probably going to stay above 168, so a call debit spread would be best fit for that. And then if earnings per share comes in worse and revenue comes in worse, I think this is going to head below $158, which would be best traded with a put debit spread. And then finally, for Costco this week, the expected range is between $468 and $508 for the end of the week. You have supports at 481.04, 473, and 463.86. You have resistance at 497.58 and 511. If their earnings comes in better than expectations and the revenue comes in better than expectations, I think this could go above 500. If their earnings per share comes in better, but their revenue comes in worse, then I think this is going to stay above $485 or so. And then if they miss on their earnings per share, but they beat on their revenue, I think this will hold the $481 level. And finally, if they miss on both the revenue and their earnings, this is probably going to head below the 473 mark. So that's my analysis for the three stocks that I'm watching this week: Costco, Zoom, and Target, as well as my expectations for SPY. Hopefully this video was useful for you. If it was, show some love, leave a like. Thanks for making it all the way to the end of this video, and thank you to all my patrons, my channel members, and as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.